Hi, so today let us talk about how we can start financial planning. Financial planning includes a lot of stuff, but begin with, we can start by thinking about our expenses. We can start by thinking about, the financial instruments that we want to invest in. And then under these financial instruments, what are available to us include mutual funds, national pension scheme, in tier 1 and tier 2, be in ATCCT1 and ATCCT2. ATCCT1, you get to invest 50,000 rupees in annually, on which you can save your tax. In terms of what your employer can contribute, comes under ATCCT2, which is capped at 10% of your basic salary. Apart from that, public provident fund, PPF, employee provident fund, and voluntary provident fund are there. For employees who work in US companies, there are RSUs and ESPP. For employees who work in Indian companies, there are employee stock options, ESOPs. Then you have, the debt instruments like fixed deposits from banks or from corporates. From corporates are the ones like one from Bajaj Finance, which give you up to onward of 7.5% fixed deposit rate in October 2022. And then you can have stocks investment in terms of direct stock investments, or it could be even a gold investment, which I recommend should be ideally through sovereign gold bonds from the investment perspective. And last, maybe the crypto and NFTs. But how to choose from all of these? From fixed or debt instruments, I would recommend, how you can choose from all of these. It could be your simple FDs from the banks or FAA rated corporate FDs from likes of Bajaj Finance, which is offering you a higher interest rate and with a surety. Then you have your provident funds, the EPF and PPFs, wherein you get a sure shot 7 plus percent of interest rate, and you don't have to pay taxes on the maturity amount. On every other amount, you have to pay interest, and the rates are what is mentioned in the brackets here for each of these sections. So, all of these sections in terms of PF, EPF, PPF, there is no tax on these because even when you invest, you can take a benefit of section 80C, and when you redeem them also at maturity, you don't need to pay interest, so they are tax free. So high returns you can get through another instrument, which is equity, or through mutual funds. It could be through index funds, which are like a lesser risk instrument because you get to invest in a basket of stocks. And there is a direct stock investments, but that gives you a little bit higher risk since your stock investments are skewed towards one particular stock or maybe a group of stocks. And it can be a make or break situations, which may also be called as a having all your eggs in one basket. Last, towards the end, I would like to talk about these four magical formulas. What are these? These four formulas can help you to find how much you can save for retirement. What tenure of loan should I take? Should I buy a term insurance with 1 year premium, 5 year premiums, or pay it for 30 years? And much more. Let us see how. So present value or the PV formula within Excel or Google Sheet can help you find how much you need today to have like 50,000 every month for rest of your life. Future value FV can help you find how much your investments would be in, let us say, 10 years. The rate formula would help you find out the interest rate you are getting out of your SIPs, the interest you are getting out of some of your investments, be it your home investments or many more. NPER, or the number of periods, help you find how many years would maybe rupees 1 crore suffice if I want to withdraw rupees 10 lakh each year, given that I am having 7.5 percent interest every year. Last, towards the last, also the term insurance. This is better than the unit linked insurance plans, and I would recommend not never to mix an insurance investment with anything else. A typical question comes whether you should, go for 30 years term plan insurance or a 5 year or a single installment. Often the 5 year or a single installment may look more lucrative, and these are just the numbers that I have got from an insurance portal, which you'll just look at now. And these Excel sheet I have linked in my description as well. So insurance company would make 90 lakh. I would see 90 lakh when you invest in one go. For you, it looks like you are doing it in a cheap way. It is like a 3 lakh 41,000 versus a 7 lakh 2,000 in case one when you pay for 30 years. But there is an opportunity cost to that money, and there I have calculated it at different formula percentages of return that you can expect from equity. 12% is a very convenient return that you can expect. So essentially, the conclusion from this is that, so if you choose to give 30 installments against one or maybe five, and keep the rest of the money invested in the right instruments, which could give you maybe a 10 to 12% kind of a return, it would make a lot better financial sense, as is evident in this calculation that you just saw. And the sheet is obviously there in the description, as I already mentioned. And a lot of these things, a lot of these formulas help you a lot. So let us just summarize. So we talked about how you can, invest in various different instruments, be it from terms of expenses, and there should be maybe an emergency fund as well, which I forgot to mention, which should be in a liquid asset and should be equal to 6 months of your expenses, if not salary, and maybe 12 months for some risk averse investors as well. And then we talked about what are these different instruments, including all of these, and how you can distribute based on your risk appetite in all of these instruments. We also talked about these four magical formulas from future value, present value, and other perspectives. So that was all from my side. Thank you.